Thank you very much. Some of you I saw last week, so some of this material will be familiar. Okay. So my job is to basically speak about this lending regime insofar as the transition to not it's just that's another question. So that's what I'm going to speak about. So you may all be familiar with the Just Energy Transition Investment Plan. In front of you is a breakdown of what is the committed financing and the sources of the committed financing. We can see that loans dominate much of the financing. Oh, do we know what the JET? I feel like we've been speaking about. Okay, the Just Energy Transition invest or partnership is a deal that has been brokered between South Africa and 5 other countries, right, including the EU, and it's an $8.5 billion of committed financing. Okay, and then you have the investment plan, which tries to mobilize beyond that scope, beyond the 8.5 billion, to mobilize to the tune of, I think, 1.5 or something trillion, right? So that is the JET IP. It's meant to finance our energy transition. So what you have there is the sources of financing of the committed financing, which loans dominate more than grants do, right? Now, the investment plan has identified a 97 billion funding gap, right? And key to the financing model is around de-risking, and I'll explain what that is, through blended finance, and that is when public money and private money are put together towards financing whatever investment projects. And then public-private partnerships, which are a kind of procurement a procurement modality where the private sector is basically concessioned to deliver particular services, right? And that comes in a number of modalities. You have modalities where the private sector basically operates and builds the project for, I don't know, 20 years. You have certain modalities where they end up owning that particular infrastructure. So there are different types of public-private partnerships, right? And these span a range of sectors. So that's basically what underpins this financing model. Right, sorry. Askis, something happened. Okay. So this is the breakdown then of where the financing is going. You'll see that much of the committed financing is going to electricity infrastructure, right? And key to this is an acceleration and the rollout of independent power producers, which are in fact public-private partnerships, right? That are just in the energy sector. And then 0.3% of committed financing is going to the justice element, which is around economic diversification and innovation, and 0.1% of committed financing is going to skills development. So the key questions that I'm addressing here is, can the needed financing be raised through the JET IP? And of course, and by the needed financing, I'm talking about the 97 billion. Can this modality actually generate or raise that amount of money? And then what are the risks, fiscal, legal, policy, socioeconomic, of this investment plan? Let's just talk, and within that, I will talk about like now that we have this 8.5 committed financing, what are the risks of such? So the key takeaway point is no, it won't be able to raise that amount of funding, because it uses what we call a risk-based prudential macroeconomic framework, which Dominic kind of started to talk about, right? And secondly, as a result of which, the kind of model that it uses basically undermines the pace of the transition, because now you are subjecting the pace of the transition to private capital, right? That has a number of biases, okay? And then on top of which, you are doing so in a way that is costly, but also very risky as well. And then will undermine the justice elements of the energy transition. Okay, so let's talk about meeting the financing gap. So the JET IP is set within a risk-based prudential macroeconomic framework. So it's basically around austerity, right? So that's what it is. Okay, so it's around surplus budgets. It's around like making sure that we don't spend too much. We cut. We do budget costs. So that's basically what fiscal conservatism is. Now, within this, the logic of this is that the government does not have enough money to finance its development. Or our development, sustainable development. So because of a limited, what it calls a fiscal space, there's limited amount of money to finance through the budget. What then we do is that we ask the private sector to finance our development, right? So the World Bank or others, part of the G20, they have this idea of, let's take the billions that are in the public sector, right, and convert them through de-risking means to the trillions that are in the private sector. So we get trillions from the billions we have, we can actually mobilize trillions in the private sector that then can fund our sustainable development. So we know what the Reserve Bank is, right? Now the Reserve Bank has a mandate. And the Reserve Bank's mandate is where you understand this idea of monetary conservatism. The focus of the Reserve Bank's mandate is really around price stability, right? Ensuring price stability, an inflation target of a particular target, right? And the way in which that target is enforced is by through the interest rate. Well, it believes that it can enforce that through the interest rate. And what you heard from my comrade Dominic's presentation, the Reserve Bank, they'll say that we are doing this to maintain so that we don't have high inflation that can undermine poor people's money when they go and buy food. But actually, what it's preserved is currency levels, and it's preserving the like when financial actors start, it's preserving, it's called arbitrage. So it's preserving like the value that the private sector can get from buying bonds in South Africa. So it's meant to attract foreign capital, right? So you do that by ensuring high interest rates, right, that ameliorate the inflationary, because inflation would undermine the value of those bonds, right? And it will limit your ability to attract foreign bonds. So this is what he was talking about. So this is actually what the political strategy behind monetary conservatism. So oh gosh, guys, are you serious? Okay, sorry. And then there's industrial conservatism. Again, that is understood as again, government does not have enough money to spend on any kind of developmental agenda. So But in South Africa's case, we might have industrial policy or green industrial policy ambitions, but actually these green industrial policy ambitions are misaligned with the kinds of macroeconomic financial resources that are required to meet the ambitions, right? So that's the idea of industrial conservatism. Other people call it actually privatization as well. That's also part of industrial conservatism. Kamal, my friend, there's a lot here. So, okay. So this is basically the macroeconomic framework that we operate under. It is one that is fiscally conservative, meaning there is not enough fiscal space. That's what they say. Therefore, we need to go to the private sector to fund our development. It is around monetary conservatism, which means that the main focus of the central bank is to ensure price stability, low inflation, high interest rates, and financial stability. Those of you who have read the JIP would have seen financial stability as a key principle in that JIP. Industrial conservatism, again, we may have these ambitions of building, of ensuring that we have localization in our industrial policy for a green, diversified economic base, skills development, whatever. But the money is not matching that ambition. Why? Because it's constrained by our fiscal conservatism, it's constrained by our monetary conservatism, and then there's a privatization agenda behind it as well. So that macroeconomic framework is operationalized by two concepts. One is market fixing, the market fixing strategy. What underpins this strategy is to say financial markets, whether it be banks, it be pension funds or institutions or whatever, the stock market, whatever, the reason why they're not financing the green agenda is because they don't know the difference between what green is and what brown is. Not Dominic Brown. So they have no idea. There's what they call an information asymmetry. So we need to develop green taxonomies, right? The National Treasury needs to develop these green taxonomies that define what green is and brown is. Then they can take this information and then internalize it when they are pricing various assets. And through doing that, because now you'll price brown activities higher than you price, green, then once you do that, then they will invest. That's what they say. So this whole thing is an information asymmetry issue. They don't have the information. So now but then what is key to this is that it works under a voluntary basis, right? You will see in the JIP, it speaks to the fact that the National Treasury has been working on green taxonomies for the financial sector, and this is done on a voluntary basis where they voluntarily accept what is green and brown, and then they use that information. The idea is that they will just automatically do this. They don't need to be pushed in any way. And the second strategy under which this underpins this is the de-risking strategies. And this is the idea of mobilizing cheap public money to subsidize basically private finance in the hopes that you will turn the billions of public money into the trillions in the private sector. That's at its very core, right? Is what de-risking strategies are. But it's not only about money, but it's also about managing political risk, because some of the activities like infrastructure and all that, a lot of infrastructure is accountable to the public, right? So how do you change the regulatory setup so that those infrastructures are so that you can actually make money off those infrastructures, basically, right? And you can protect the private sector from the scrutiny of the public, right? And so it's around managing those political risks where there would be claims from the public that the private sector would have to respond to. So how do you ensure that they are not those political risks are managed, right? So these are that's part of how you de-risk money. Now, I've just explained this macroeconomic framework and the various strategies to answer the question of whether or not this particular prudential macroeconomic framework will be able to raise the financing that is required. Well, it will hit against particular structural impediments, right, that actually undermine and underestimate actually the structure. So the risk-based prudential macroeconomic framework undermines or underestimates rather the structural impediments that are required to appropriate resources. So when we think about like the fossil fuel sector, right? The fossil fuel sector is one that is highly concentrated. There's a lot of oligopoly, like very monopolistic, highly what they call vertically integrated, where different parts of the chain are owned by like very few companies, right? And what that allows is that when you have that kind of concentration in the value chain, right, you are able to get cost reductions, right? You can negotiate better to get cost reductions. You can engage in certain expansionary projects that support growth, and you have stronger negotiating power. And these are features of a highly concentrated industry, make it more attractive to what they call institutional investors. And institutional investors are basically the people that manage our pension funds, right? Those in essence are institutional investors or private equity. These guys have basically come together to manage, and they're the ones that dictate where the money goes. And they want to take the money where it's clear, it's clean, it's easy, where they know they'll have predictable returns, right? And then another thing is that, however, the renewable sector is currently very fragmented. The supply chains, with supply chains that is relatively less integrated, so less monopolistic in the way in which the fossil fuel, which has established itself for many years, is, right? And this could be seen in some way of okay, sure, this is because it's a budding industry, it's new. It hasn't established itself in the way that the fossil fuel industry has, but it's also a structural feature of the technology. Solar and wind power are more globally distributed than fossil fuel reserves, and renewables are typically not internationally traded in terms of dollar-denominated ways, okay, like the fossil fuel industry is. Therefore, this it also exposes these institutional investors to currency risk, because they don't want to trade in things that are in Zambian shillings. You know what I mean? Like, they don't want that. They want dollar-denominated assets. What will Zambian shillings do for them? Right? So that is, if it just depreciates, that undermines the value of the assets, right? So you want something that is dollar denominated, and the fossil fuel is dollar denominated. What this tells you is that is the degree to which these guys are very carbon biased, because they're working off a fossil fuel industry that is highly subsidized, lots of sunk costs, lots of money that has gone into it over time, right? And therefore they'll just keep on milking this thing, right? And if you define the pace of your transition through private finance, that's what you'll get. And you'll try and de-risk and de-risk and de-risk, but at what cost, right? To the pace of your own transition. And then there are also something called regulatory arbitrage, and this is when, so for instance, okay, maybe there's success then in putting together regulations that monitor certain commercial banks, or that they have to like adopt green taxonomies. This idea that they cannot invest, or, you know, I know the Fair Finance Coalition, I know they have campaigns around ensuring, correct, that IFIs don't invest in particular ways, right? They don't invest in dirty energy or commercial banks. So there's a lot of public pressure around how people invest. That is great. The challenge is that you have certain what they call off-balance sheet financing. You also have shadow banks. You also have private equity. The value of that is in the trillions, right? These types of institutions, they operate outside of regulatory norms, making it very hard for you to then track where they're actually investing. And so let's say there's a commercial bank that is being regulated in the sense that there are policies in place to say, Standard Bank, we need to see that you're investing in green and not brown. Okay, let's say there's such a regulation. Well, then Standard Bank has something called Stanlib or whatever, which is its private equity firm, that then it offloads its assets into that opaque structure that nobody knows about. And so because of the anarchic global financial architecture we operate in, it means that the likes of Stanlib and other types of asset manager, private equity firms can continue to invest in these ways, right? And again, because of the terrible regulatory system, you will continue to see this kind of investment that goes that is basically covertly operating. And then there is the policy incoherence, right? I know I'm bad, right? Okay, there are whole sets of slides that I'm not going to even share with you. And I'm sorry for that. I'll upload them. We can talk during our break. But there's also this idea of policy incoherence, where the UK, that is one of the few reserve banks, whatever you can, central banks, that has an explicit environmental mandate. Okay, so meaning that its mandate is not just about inflation targeting or price stability. Its mandate is around the environment, right? So you think that, okay, so you think by so doing, then it will consider issues of the environment when it does its operations and it dispenses credit and the like. But the challenge here is that what you've actually seen in this because that particular reserve bank does not, it works on the basis of sector neutrality. So any sector, doesn't matter, green, brown, like it may, how can this function? Basically, you can change the types of interest rates you set, right? Making them higher, for instance, for dirty sector and lower for clean sectors. And then those are dispensed throughout the various financial institutions. So in all the commercial banks, then it means that the way in which they set interest rates for dirty will be higher than they do for green, right? The challenge is that that central bank does not discriminate in that way. It has a green mandate, but it's actually ineffective because it does not have any kind of discrepancy between what is green and what is brown, right? And so what then happens is that, for instance, now when there was the energy security issues, the energy crisis in Europe, issues of price stability and inflation targeting, and you can see how austerity is rising, has taken precedence over its green mandate, because now they're investing in fossil fuels, or they're trying to get other types of so basically there's kind of like a drop in the green mandate because the Reserve Bank actually has its primary focus is around inflation targeting. Okay. To stop. Okay, let me conclude. So yes. So basically what I was trying to set up is a discussion around how, when we are actually working within this kind of paradigm or framework, we are undermining the chances of an energy transition, because the pace of it is being dictated to by the private sector that is highly, and that financial model is highly carbon bias, right? And so that is what is at stake when trying to go that route. But also, there are also other fiscal and legal risks that I unfortunately cannot get into, that the private pathway of the transition engenders, right? And these are things that I think I've spoken about several times with some of you, but I hope we'll take them up in questions. Sorry, thank you.